In this video, we are going to talk about goods and services tax. As we all know, the Goods and Services Amendment Act has recently been passed by the Indian Parliament, so it becomes an important act to read and understand. In this video, we are going to talk about the following things. First, the background of GST or the basics about GST. Secondly, we'll talk about examples as to what is GST, what GST comprises of. Thirdly, we'll talk about basic provisions of GST and then the advantages that GST brings to Indian taxation system. Then we'll talk about the 122nd GST Amendment Bill, which has been changed to 101 Amendment Act. And lastly, we'll talk about the expected questions in interview on goods and services tax. So let's talk about the basics or the background of GST. First of all, it's important to understand the difference between direct tax and indirect tax in order to understand GST. There are two things which differentiate direct tax from indirect tax. Number one, liability of payment, and number two, burden of taxation. So, liability of payment and burden of taxation. In liability of payment, we mean the liability of paying the particular tax. For example, if this is the government and it's supposed to take tax from A, then A will be liable, is the person who is liable to pay tax to the government. But the burden of taxation may not lie on A. A is the person who is supposed to deposit the tax to the government, but when we talk about burden of taxation, the burden of taxation may lie on B or may also lie on A, depending upon the type of tax. So, in a direct tax, the relationship finishes here, which means that the liability of payment as well as the burden of taxation lies on the same person. So, A, who earns income, has to pay income tax on his income. So, the liability of payment towards the government lies on A, and the burden of payment also lies on A. So, he has to submit the tax, and he has to submit the tax from his own income. This is the relationship of a direct tax. Whereas, when we talk about an indirect tax, the relationship is this. In this case, the liability of payment lies on A, but he can transfer the burden of payment, which means that he can ask another person to submit the tax on his behalf, whereas he will be the responsible person to submit the tax to the government. Let's take an example. If A is a retailer who sells certain goods, he sells goods to B, B pays money to A, which includes certain tax. If A sells goods worth rupees 100 to B, which includes tax of rupees 10, then B is the person who has paid this 10 rupees of tax. Now, the liability of submitting these 10 rupees taxes lie on A. So, if A does not submit these 10 rupees of taxes to the government will come after A and not B. But in this case, the burden of this tax is lying on B and not on A. This is what we mean by liability of payment and burden of taxation. So, in direct tax, the liability of payment as well as the burden of taxation lie on the same person. Whereas, in the case of an indirect tax, the liability of payment lies on one person, whereas the burden of taxation lies on another person. Let's take some examples of direct and indirect tax. Direct tax has three major taxes under it: income tax, wealth tax, and corporation tax. Wealth tax has been removed by the central government. So, now we have only two classifications of direct tax, which are income tax and corporation tax. In case of indirect taxes, there are a multitude of taxes which are charged by the central as well as the state government. Some of these examples are given here: sales tax, service tax, excise duty, custom duty. We'll talk about all these taxes in brief in the future slides. Now, what is GST? GST is an indirect tax reform, which means that it is trying to deal with this relationship wherein the liability of payment lies on one person or A, whereas the burden of taxation is shifted to B. Okay, let's talk about the history of GST very briefly. It was in the year 2000 that the idea of GST was released or was started by the Vajpayee government. In 2003, the Kelkar task force was set up and it recommended a state taxation system of GST based on the system of VAT. So, it recommended GST at state level. In 2006-7, a plan for national GST was released in the union budget by the UPA government. This is why the UPA government says or claims that GST is their idea, because the GST at national level was first released by their government. In 2011, the first amendment bill of GST was put in the parliament and then referred to the Standing Committee on Finance. This amendment bill lapsed with dissolution of 15th Lok Sabha. Why is this an amendment bill? This is an amendment bill because it amends the constitution, which puts certain rights of taxation over the state governments and certain rights on the central government. This bill on GST tends to amend those list of rights and liabilities. It was in 2014, it was introduced as 122nd Amendment Bill in the 16th Lok Sabha, and it was recently passed as 101st Amendment Act. These are the various taxes which will be subsumed under the GST. Number 1, sales tax or VAT. VAT stands for value added tax. We'll talk about value added tax, the concept of VAT or GST briefly, and also the difference between them. Sales tax is the same as value added tax. It is ad valorem and it is charged over consumption. Ad valorem means that it is charged over the value of a good or a service. In case of VAT, over a good, on the value of a good, not on the unit of a good. So, if I sell you a good which costs 100 rupees, VAT will be charged on 100 rupees and not on the fact that I sold you 1 unit. We will understand the importance of this briefly. So, remember that value added tax is ad valorem, which means that it is charged over the value of a good. It is charged over consumption. This means that tax over these 100 rupees, if the tax is 10%, then 10 rupees of tax will be charged only when the good is consumed or purchased by the final consumer. Okay, let's talk about the second one, service tax. Service tax is a tax which is charged on the sale of services. This is important because VAT is chargeable only on the sale of goods and service tax is charged only on the sale of services. The third one is excise duty. The difference between excise duty and VAT is that excise duty is charged over production and VAT is charged over consumption. This means that excise duty is chargeable when a good is produced by the manufacturer. For example, if a manufacturer is producing biscuits, then excise duty will be paid by the manufacturer on the production of these biscuits, whereas VAT will be paid by the consumer on the purchase of these biscuits. Okay, so the value added tax is charged over consumption, whereas excise duty is charged over production or manufacture of a certain good. Secondly, excise duty is a per unit tax, which means that if I produce 1 lakh units of biscuits, then I will have to pay excise duty on these 1 lakh units. So, a certain percentage of tax will be charged based on the units and not based on the value of these biscuits. Whereas VAT is charged over the value. So, if I purchase a biscuit for 20 rupees and the VAT is 10%, then I have to pay 2 rupees of value added tax based on the value of the biscuits. This is the primary difference between VAT and excise duty. Next comes entertainment tax. Entertainment tax is the tax that you pay when you go for movies or things like that. Circus, movies, plays, musical concerts, anything related to entertainment is charged entertainment tax. Next comes central sales tax. Central sales tax is also called as CENVAT. Now, what is CENVAT? CENVAT is levied by the center and collected by states. A product may not be produced and consumed in the same state. This is Gujarat and this is Maharashtra. When a product is manufactured here and it travels to Maharashtra and it's consumed here. So, it's manufactured here and it's consumed here. So, it is crossing the state borders. In this case, how will tax be chargeable? In this case, central VAT comes into play, and when the borders are crossed, then central VAT is to be paid by one party or the other and given to the central government. So, it is levied by the center, collected by states. It is collected by states, but it goes to the central government's lockers. Next comes octroi. Octroi is a tax paid on movement of goods or services across state boundaries. So, if trucks are moving from one state to the other, they are charged octroi by the destination state or by the entering state. Next comes custom duty. Custom duty is paid on import of certain goods or services. So, if India imports fuel from Saudi Arabia, then an import duty would be paid by Saudi Arabia as fuel enters Indian boundaries. These are Indian boundaries. As fuel enters Indian boundaries, a custom duty will be paid or will have to be paid by the seller to the buying country. This is custom duty. These are some of the most important examples of taxes which will be subsumed under goods and services tax. Next comes the most important part, which is the idea of GST. Now, in this case, we can say that GST and VAT are equal because the concept of GST and VAT is equal. The difference being that GST is a national tax and VAT is a state based tax, that is, it is limited to state boundaries. So, when I say GST, I also mean VAT to understand the concept of GST or VAT. Let's understand the older method first before VAT, and then we'll understand the GST method. In the older method, I'll explain it to you using an example. Let's assume that the manufacturer produces something for 100 rupees and sells it for 100 rupees, produces it for X and sells it for 100 rupees. Now he will have to pay tax at the rate of 10%, which is 10 rupees. And this tax, because it's an indirect tax, will be passed on to the distributor. So indirectly the distributor will have to pay these 10 rupees. So the purchase price for the distributor is 110. The distributor adds certain value to this good and then sells it for 210 rupees in the market. there is a tax of 10% which is also to be paid by the next buyer, which is the wholesaler. So a tax of 10% on 210, which is 21, will be paid by the wholesaler. So the total value of purchase for the wholesaler comes at 231. Why I valued this as 210 is because I am keeping a difference of 100 rupees at every stage of purchase and sale. Next comes the wholesaler. The wholesaler has purchased it for 231 and it's going to sell it after keeping a margin of 100 rupees based on the value that he creates. He is also going to charge a tax of 10%, which will be 33.10 rupees on the sale price of 331. So the purchase price for the retailer here would be 364.10. The retailer will do the same thing by adding 100 rupees to his margin and selling it at 464.10. The tax to be paid by the consumer here would be 46.41 and the final price to the consumer comes at 510. Now let's talk about GST and compare it with the older method. Here also manufacturer sells it at rupees 100 and charges a tax of 10% or 10 rupees, which is to be paid by the distributor. So the distributor has to pay 110 rupees to buy a certain good. The sale price of the distributor here would be 200 rupees. Let's understand this. The margin here is 90 rupees right now, but the margin will go up to 100 in a very short while. The tax at 10% is 20 rupees out of 200. Here it was 21 because the margin was 100. Here it is 20 because the margin is 90. The margin will increase to 100 though. So the purchase price of the wholesaler is 220, 200 plus 20. Now this tax is to be paid by the purchaser, but it is being collected by the distributor to be paid to the government. When he does these two things or these two transactions, he gets credit for the tax which he has paid when he purchases a certain good. So the distributor paid a tax of rupees 10 when he purchased it from the manufacturer, and he collects rupees 20 from the wholesaler when he sells it to the wholesaler. So he will get credit of rupees 10 here from the government, and he will have to pay 20 here to the government. When he gets credit of rupees 10, his margin will go up to 100. Let's come down. The wholesaler also tries to sell it ahead, but here his margin is only 80 because he's purchasing it at 220 but selling it at rupees 300. He adds a tax of 10%, which is 30, which is to be paid by the retailer to the wholesaler, and the retailer ends up paying 330. Now he gets 30 here and he paid 20 here. So he will get credit for rupees 20, which is called input tax credit. He will get rupees 20 credit on his sale and purchase, and the remaining will be passed on to the government. So the government will be given 10 rupees here and 10 rupees here. Similarly, when the retailer goes to the market and sells it to the final consumer, he will sell it at rupees 400, keeping his margin at 70. The tax will be 10% again, 40, and the purchaser will have to pay 440 rupees. Now the retailer will get credit for the tax which he has submitted, which is rupees 30, making his margin as 100. In the end, the consumer has to pay a lesser price, which is 440, compared to the older method where the consumer had to pay higher price of 510. This difference is because of the taxes which have been charged. In this case, taxes have been charged only on the value added of the good, whereas in the more older method, tax was charged on the entire value. See here, the tax is charged on 210 at the rate of 10%, whereas here, though the tax is charged on 200, but the purchaser gets credit for his purchase at rupees 10. So the tax is in effect charged only on the value addition and not on the entire value. This is what differentiates GST from the older method before VAT, which was being followed in India, and this is how it reduces prices. Let's come to the other provisions of GST. GST combines central and state taxes as well as integrated taxes. What do you mean by integrated GST? There is a tax called central tax and there is a tax called state tax. State tax is collected by the state, central tax is collected by the center. But integrated tax is a tax which is to be collected when a good or a service passes from one state to the other. So this is nothing but CEN-VAT. The advantage of integrated GST over CEN-VAT is that in case of CEN-VAT, let's take an example. This is Gujarat and this is Maharashtra. So if Gujarat is selling something to Maharashtra, there is a CEN-VAT which is being charged. Let's say that there are two sellers here and two here. So A is selling to B, B is selling to C, and C is selling to D. When A is selling to B, there is a VAT being charged. When B sells to C, because it is crossing borders, so a CEN-VAT is being charged. And when C sells to D, again a VAT is being charged. Now what happens in this case is that the seller here, C, does not get any credit of CEN-VAT that he paid on the purchase of this particular good. So when he sells it to D, he does not get credit for the tax which he paid when he purchased the same good from B. So this results in cascading or increase in prices of goods that are being sold from one state to the other. In an integrated GST or IGST, this does not happen because you start getting credit for whatever you sell in cross-border transactions. So if you're selling something from Gujarat to Maharashtra and you're paying IGST on it, you will start getting credit for the taxes paid on purchase of that particular good or service. This is why GST is an upgraded or an improved version of the VAT. Let's come to this next provision, covers both goods and services. This is very important because VAT covered only goods, it did not cover services. This resulted in different tax rate for goods and services, and this resulted in certain advantages for people who were selling services over the people who were selling goods. By bringing them at par, it is aimed at making goods and services competitive to each other. It also aims at creating a GST Council. We will talk about GST Council briefly. Exempted goods. There is a class of exempted goods on certain goods and services which are considered very important for all the states. Petroleum products, alcohol, stamp duty. More goods may be added because all the rules of the GST have not been finalized yet. Now let's talk about advantages of GST. Number one, ease of doing business. All these advantages are interconnected to each other, so you may feel that I'm talking about the same thing again and again. Ease of doing business. Why does it result in ease of doing business? Because there is a uniformity of tax rates. As you saw before, that goods and services, number one, are being brought at par to each other. Secondly, GST subsumes loads of taxes under itself. What that does is a manufacturer does not have to pay 10 taxes, he is only required to pay one tax, which is called GST. This makes it easier for him to conduct his own business. Secondly, there is a uniformity of tax rates. When a seller or a manufacturer makes and sells a good in different states, he has to pay, or he had to pay different VATs on that, on the sale of that particular good. But now he is required to pay only one rate of tax. For example, he has to pay 10% in the entire country. So if a manufacturer is making a good in Delhi and sending it to Kerala, Haryana and Kashmir, he has to pay the same tax in all the cases. This makes it easier for him to conduct business. Secondly comes removal of cascading. We talked about the improvement of GST over the older method, and that is what is cascading. Secondly, central VAT and VAT do not offset each other. In the older method, as I told you, VAT is chargeable over different states, but when it comes to cross state transactions, central VAT is charged, which is not offset by the entering state or the purchasing state. So GST is an improvement over the older method because the cascading reduces further. Next one is reduction in costs. The costs reduce because of different reasons. Number one, you have to cascading reduces, as I talked before. You have to pay only one tax rate at multiple stages, and you're not required to pay different taxes. Thirdly, your administrative costs also come down because you are required to pay tax at only one stage and not at multiple stages. There are loads of benefits of GST. Lastly, the effective rate of tax also comes down. So if GST is at 18%, it is much lower than the tax which the manufacturers and the sellers had to pay before, which was more than 30% because they had to pay number of taxes, but now they are required to pay only one tax, which is 18%. Controls on leakage. How does it control leakages? Because when there are multiple taxes and you stop getting credit for those taxes, you start selling and purchasing goods without bills, without a TIN number and without bills. But in case of GST, people identify the advantage of getting a TIN number and selling goods with bills because they get credit for whatever they sell. So the leakages also reduce. Tax base. Tax base refers to the number of people who would pay taxes. Tax base comes up in any country when you are required to pay a tax which is easier to pay and on which the tax rate is bearable. So if the tax rate is too high, say 35%, you will not be able to increase the tax base, and you can increase the tax base by making the tax method of taxation easier and convenient for the consumers. Next is integrated GST. We have already talked about integrated GST and how it is an improvement over the older system of VAT. Tax evasion. Tax evasion happens when people stop paying taxes. We have talked about this. Tax evasion is reduced because people start using bills to purchase and sell goods and services because they think or they start thinking that it will be in their advantage if they start buying goods and services by paying the taxes that they are required to pay. Last is cross utilization of credit in goods and services allowed. This is very important in the VAT system because the VAT and service tax were different, so there was no cross utilization or cross credit of taxation. So if a person is making a good and a service and paying taxes on both and finally selling a good which combines both of them, he will get credit only for the good and not for the service. This will not happen in GST, and people will start getting credit for both goods and services together. Now let's talk about the 122nd GST Amendment Bill or 101 Amendment Act. The central and state tax working simultaneously within a state. In a state, you can see here the central and state taxes are working simultaneously. A person pays SGST at the rate of 10% on rupees 100, and at the same time he also pays CGST, which is central GST, at various places or at various phases of purchase and sale of a good. He pays state GST and central GST simultaneously. This was not happening before, and people had to pay state VAT separately and central taxes separately. This is an advantage wherein both will work simultaneously. The council, this is very important. The objective of council is threefold. First of all, to recommend union and states on important issues related to GST. This is very broad, so anything which comes under GST and looks important to the GST Council can be taken up by them. To recommend on GST rates, so the council will be the one deciding upon the rates, and also to decide upon special rates. So special rates are dependent or are described by the Arvind Subramaniam committee. You can look up that committee's recommendations about special rates. Who all will be the members of GST Council? The chairperson will be the Union Finance Minister. These all will be the ministers of GST Council, Union Minister of State in charge of Revenue or Finance. So a minister, a Union Minister of State who is in charge of Revenue or Finance will be a member, and the other members will be state nominees. It is being provided in the act that preferably the states have to recommend a state minister of finance to the GST Council, but they can also recommend any other name. So these are the three broad classifications of members. Lastly, we'll talk about the expected questions in the interview. Can you explain GST in one sentence? This can be asked because the board is very specific about the statements that you use or the words that you use in your answers. GST is an indirect tax reform, very important. It is not related to direct tax, it is an indirect tax reform meant to consolidate, another keyword, and simplify indirect taxation in India among all states. It paves the way for a national combined market for all taxes imposed on manufacture. Manufacture would be excise duty, sale and consumption, VAT, of goods and services. These two statements can be either used together or isolated manner in order to explain the meaning of GST in one sentence. How will GST help Indian businesses, government and people? We have already talked about this. How is it going to be advantageous to different organizations and the people? Can you explain destination based principle? Destination based principle has been introduced in GST. This means that if there are two states, state A and state B, and a good moves from A to B, then GST will be paid to state P, which is the state where the good is finally arrived and consumed. So it means that a good or a service will be paid by the importing state. Now this has its own advantages and disadvantages, but this is being used in GST because of two reasons. Number one, this is the principle which is being used worldwide, making it important for India to also use it. Secondly, it will make the exports competitive and imports less competitive for India. So it can result in an increase in our exports and a decrease in our imports, because no taxes will be paid over exports, whereas taxes will be collected by the importing state when a good or a service is imported. Can you tell us what is IGST? I have explained integrated GST. It takes place when a good is transferred from one state to another. Do you think government will be able to roll out GST by April 2017? This is a very casual question which can be asked. Be prepared to answer such questions in a manner that do not get too serious, but at the same time show that you understand what they are demanding. How is GST different from VAT? We have also talked about this. It is SEN-VAT and IGST and good and service cross credit, where GST differs from VAT.